everybody tried to do the same thing. And of course, everybody crowded in, and the low-hanging fruit that Ben Graham had a lot of because of the Great Depression has gone away.
Graham, incidentally, one point, important point, Graham was not scalable.
The real money was in the really great companies,
Right.
which carried you up and up and up and up and up.
Those sub-working capital stocks are just almost impossible to find now.
At any rate, what Ben Graham did that was so interesting is that he taught that you should find a few good things and stay with them for a very long time. But a long time to him was a few years. It wasn't a few decades. And he did that for like 40 or 50 years in a little investment partnership with incentives and so on. And his investors, who were by and large not very rich, did very well with him. After he got his share, they got a good cut that was higher than what other people got after fees. And so he delivered a valuable product. And he taught you got into things, it could be a lousy business, but they were cheap enough, they're still all right if they had enough assets per share. Right. So you're getting at least twice as many assets as you were paying for. Yeah. And he just floated around for the best available stuff among companies, good and bad. Yeah. That was his system. And he had worked for 50 years. His clients had good returns. Well, after he became so famous, partly with the help of Warren Buffett and Warren Buffett's success, everybody tried to do the same thing. And of course, as everybody crowded in, trying to be a little Ben Graham, it got more and more competitive. And that's what's happened now. And the low-hanging fruit that Ben Graham had a lot of because of the Great Depression has gone away. And if you just try and float from one undervalued bad business into another and pay all the costs and so forth, it just doesn't work well enough for the people that actually put up the money to be worth bothering with. That's the way it works now. But in Graham's time, it was the best way there was.
Well, your upgrade on that was to just look for good businesses.
I saw immediately that Graham was wrong.
Right, and you look for...
And the real money was in the really great companies,
right,
which carried you up and up and up and up and up.
Is it...
And whoever, but I did not really think that we'd ever have one that would, just so many hundreds of billions in Berkshire. I did not anticipate when Warren and I were starting with our little piddly start that we'd ever get to 100 billion, much less several hundred billion.
Right.
It was an amazing occurrence.
What happened that you didn't anticipate? What led to that success?
Well, we got a little less crazy than most people, and a little less stupid than most people, and that really helped us. Then in addition, we were given this much longer time to run than most people because something kept us alive into our 90s. And that gave us a long track from our little fiddling start all the way to the 90s. Those are the two things that really happened. And of course, we wised up over time. We got into better and better companies, and we understood more and more of the bad things that could happen to you and how easy they could creep in. And we avoided them even more assiduously when we were old than we did when we were young. And it all worked. When you found Ben Graham, he was unconventional, and he was very smart. And of course, that was very attractive to you. And then when you found out it worked and you could make a lot of money while you're sitting on your ass, of course, you were an instant convert. And so...
It still appeals to me, actually. I mean...
But the world changed. Before he died, Ben Graham recognized that the exact way he sought undervalued companies wouldn't necessarily work for all times under all conditions. And And that's certainly the way it worked for us. We gradually morphed into trying to buy the better companies when they were underpriced instead of the lousy companies when they were underpriced. And of course that worked pretty well for us. And Ben Graham, he outlived the game that he played personally most of the time. He lived to see most of it fade away. I mean, just to find some company that's selling for 1/3 of its working capital and figure out it could easily be liquidated and distribute $3 for every dollar of market price. Lots of luck if you can find those in the present markets. And if you can find them, they're so small that Berkshire wouldn't find them of any use anyway. So we've had to learn a different game, and that's a lesson for all the young people in the room. If you're going to live a long time, you have to keep learning.
Yeah.
What you formerly knew is never enough. So if you don't learn to constantly revise your earlier conclusions and get better ones, why, I always use the same metaphor. You're like a one-legged man in an ass-kicking contest.
Yeah. If anybody has suggestions for another metaphor, send them to me. Graham, incidentally, one important point, Graham was not scalable. I mean, you could not do with really big money. And when I worked for Graham Newman Corp, here he was, the dean of all analysts, and he was an intellect above all others around that time. But the investment fund was $6 million, and the partnership that worked in tandem with the investment company also had about $6 million in it. So we had $12 million we were working with. Now you can make adjustments for inflation, but and everything. But it was just a tiny amount. It wasn't really scalable. And the truth is, Graham didn't care because he really wasn't interested in making a lot of money for himself. So it had no reason to want to find something that could go on and become larger and larger. So the utility of Chapter 8 in terms of looking at stocks as a business is of enormous value. The utility of Chapter 20 about a margin of safety is of enormous value.
My name is Martin O'Leary, and I'm from Houston, Texas. My question to you is this. In your annual report this year, in the letter to the shareholders, you indicated that it was 50 years ago that you met Benjamin Graham and that he had a major impact in your life, especially in your investment success. Moreover, you've stated in the past that The Intelligent Investor is by far the greatest book ever written on investing. One of the central tenets in the book was that if you bought a group of stocks, say 10 or 20, that traded at 2/3 or less than net current assets, that you would be assured of a margin of safety coupled with a satisfactory rate of return. Today, if you were to find 10 or 20 stocks that traded at 2/3 of net current assets, would you be inclined to purchase those stocks for your own personal portfolio, not for Berkshire Hathaway? And the second question, since I've mentioned the book, I was wondering which books that you and Mr. Munger have been reading lately and would recommend. Thank you.
Yeah, in respect to your first question, you could probably, if you found a group like that, and you won't, I don't think, you'd probably do all right buying the group. But not because the businesses themselves worked out that well over time, but because there would probably be a reasonable amount of corporate activity in a group like that, either in terms of the management's taking them private or takeovers or that sort of thing. But those sub-working capital stocks are just almost impossible to find now. And if you got into a market where a lot of them existed, you'd probably find wonderful businesses selling a lot cheaper too. And our inclination would be to go with a cheap, wonderful business. I don't think you'll get in a high market or something close to it. I don't think you'll get a lot of sub-working capital stocks anymore. There's just too much money around to promote deals before they really get to that point. But that was a technique. It was 50 years ago. And is Walter Schloss here still? Walter, are you here? Stand up if you're here. I met Walter 50 years ago when I met Ben Graham. And I know Walter's came out this year, but he already knows everything I've been talking about, so he may have left. Walter actually, his practiced in securities much closer to the original. He's run a partnership now for 46 years, I guess it is, and he's done it much more with the type of stocks that Ben was talking about in those days, and he has a record that is absolutely sensational. That is far better than people who get promoted and go on television shows and do all of that sort of thing. And he's done it in what I tend to call cigar butt companies. You get one free puff, and that's about it. But they don't cost anything, and that was the sub-working capital type situations. Walter's had to extend that somewhat, but it's been a great record over a considerable, 46 years, a very considerable period of time. So I think if you found that kind of a group and did it as a group operation, and Ben always emphasized a group operation, because when you're dealing with lousy companies, but you expect a certain number to be taken over and all that, you better have a group of them. Whereas if you deal with wonderful companies, you only need a couple. But I think if you see that period again, we'll be very active, but it won't be in those kind of securities. Charlie?
Yeah, and there's another change. In the old days, if the business stopped working, you could take the working capital and stick it in the shareholders' pockets. And nowadays, as you can tell from all the restructuring charges, when things really go to hell in a bucket, somebody else owns a lot of the working capital. The whole culture has changed. If you have a little business in France and you get tired of it, as Marks and Spencer has, the French say, "What the hell do you mean trying to take your capital back from France? They're French workers in this business." And they don't care about, they don't say, "It's your working capital, take it back when the business no longer works for you." They say, "It's our working capital." The whole culture has changed on that one. Not completely, but a lot from Ben Graham's day. There are a lot of reasons why the investment idiosyncrasies of one era don't translate that perfectly into another.
That list that was published, I forget whether it was published in the 1951 edition of Security Analysis or the 49 edition of Intelligent Investor, but there were a list of companies there. There was Sacco Lowell, there was Marshall Wells, there was Cleveland Worsted Mills, there was Foster Wheeler, and all those companies were sub-working capital companies selling at 3 or 4 times earnings. And there was if you bought a group of stocks like that, you were going to do well. But you certainly don't see that in companies with any size today. And I've seen a few lists of tech companies selling below cash, but they're determined to use that cash, and it may not be there in a year or two. It was a different breed of animal to some extent in Ben's list at that time.